Hello and welcome to James Talks Property. My name's James and this is episode 1 of helping you grow your knowledge and understanding about the property investment market in the UK. This is the start of a series where I will help you and other beginner investors grow your knowledge and understanding to mitigate risk and help you build long-term wealth through property. Before we get into it, please don't forget to like and subscribe if you like the content. So, why am I doing this channel? The reason for this is I don't believe in property courses. I don't believe that you should pay money that you save to invest in property to someone who's charging a course and essentially using that money to build their own property portfolio. What I do believe in is giving good quality, free education away to help people grow their knowledge and their wealth over time so that you know what to invest in or what strategy is right for you and help you mitigate your risk along the way. For those of you who don't know me, my name's James. I've worked within the property industry for the last 5 years and helped thousands of investors plan and grow long-term profitable property portfolios. The reason I'm starting with the basics is because I had a conversation with a lady called Rachel 2 weeks ago. She was introduced to me through a friend of a friend, and she had a pot of cash that she wanted to invest in property. Some of that was through savings because she had quite a good job. She also had some inheritance, so she wanted to utilize this cash as best she could within property and property investment. The problem was when she started to do research, she found a lot of conflicting information about lots of different strategies. She didn't know where to start, and she also didn't really know in depth the difference between each strategy. That brings me on to today's video, which is all about the 5 main property investment strategies. I'll talk you through what they are and who they benefit most. So, the first strategy is buy-to-lets. Buy-to-let is essentially where you purchase a property, you rent it out on a standard AST to a tenant. That could be professionals or a family. You make a very small rental profit in the short term. That might be £200, £300 a month, but benefit from the long-term appreciation of the asset over time. This often gets a little bit of a bad reputation for not being the sexiest strategy and not being able to make lots and lots of money immediately. However, it's a very, very good long-term property investment strategy for anyone that's wanting to build their wealth over the long term or achieve a long-term financial goal. The next strategy is flips. So essentially what flips are where you purchase a property, you add value to that property through a refurb. So that could be creating space like an extension, a loft conversion. It could be small things like changing the kitchen, putting a new bathroom in the property, and essentially selling the property out the back end and making a profit in the meantime. Obviously, this strategy is a lot more risky than buy-to-lets because you need to add enough value in which you can sell the property and make enough money out the back end to make a profit after you've paid taxes and everything like that. But if you do it right, it could be a great way to build your wealth quite quickly. So you could do maybe 1 project or 2 projects a year to really build your wealth in a shorter space of time. However, you obviously need time to do it. You need quite a lot of cash to start because I would always recommend looking at buying in cash rather than using bridging finance, which is short-term, high-risk finance, which we'll discuss in another video. But it could be a good way, if you've got the cash available, to really build your wealth quite quickly. The next strategy is another project-based investment strategy, which is buy, refurb, refinance. So the premise of a buy, refurb, refinance model is you buy a property, you refurb that property, and you then refinance out the back end with a mortgage. So what that looks like is you buy a property for, let's say, £100,000. That property needs work done on the property. So maybe nobody's lived in there for a few years. It's old, it's tired, it maybe hasn't had an extension, whereas other properties on the road have, so it's valued significantly lower than some of the other property on the road. What you'll do is you'll buy that property, you'll add value to that property like you would do in a flip. That might be through creating space, again, extensions, loft conversions, a full gut and refurb of the property, and you then get a mortgage on the back end of that at the higher value. So let's say you buy for £100,000, you spend £50,000 on the refurb, you then get it revalued at £200,000, and you can release the £150,000 you spent on the property so you can recycle, build your portfolio, and go from there. It's not always the most straightforward strategy. It's one that sounds very good and gets a lot of clicks online. However, it's not the easiest strategy. You need experience with projects. You need the time to be able to do it. You probably need to buy in cash again, because again, you can get bridging finance, but again, bridging finance is high risk, short-term finance. And if you've never done a project before, I would not recommend taking bridging finance on your first project. The next property investment strategy is short-term lets or serviced accommodation. Short-term lets are where you purchase a property with the idea that you're going to rent it out on a nightly basis. That could be through platforms like Airbnb, but it could be through other platforms or through companies. But essentially, you're going to rent the property out on a nightly basis or a weekly basis rather than a monthly basis to a family or professionals. The reason some investors choose to do this is because it can mean, if you get the right property at the right location, that you make a better cash flow in the short term, and you also get the benefit of appreciation of the asset if you buy the right property in an area of growth. Having said that, the serviced accommodation strategy isn't as profitable as maybe it once was. The reason for that is COVID. Once COVID hit and people couldn't go on holiday abroad, a lot of people recognized that and flooded the market with short-term let, serviced accommodation, holiday lets. What that meant was, with all those properties coming to market, obviously demand was through the roof and people made quite a lot of money in quite a short space of time. However, once people could then go abroad again, competition had increased dramatically, demand had dropped through the floor, which meant that the average serviced accommodation was making a lot less money, and you need to pay for things like management and cleaning. The final strategy is HMOs. A HMO is a house with multiple occupancy, which basically means a person or an investor has purchased a property and converted it in line with legislation to a property that will be rented out on a room by room basis. So what that means is, in theory, you can have a really strong cash flowing asset because you're renting the property out on a room by room basis rather than as a property as a whole. However, it's not always as straightforward as that. You've got to look at a lot of different things when you're looking at HMOs, including maintenance, management and void periods that you wouldn't necessarily have to deal with as much with things like buy-to-lets. And the reason for that is, if you're renting out on a room by room basis, look, there's a lot more people that could move out. There's a higher turnover. You have to pay for things like the heating, the electric and everything from that perspective. So sometimes it's more of a marketer's dream than it is an investor's dream. Having said that, there is definitely an argument to have a HMO as part of a diversified portfolio. So the key considerations when looking at this. The first is the time you've got available. If you don't have much time available, you're not going to do project-based property investment. So that is flips and refurbs. If you do have the time, it could be something you can consider, but you need to be able to do it in an area which is relatively local to yourself. So I wouldn't do flips or refurbs anywhere more than an hour away, because you will have to go to the property even if you're not planning on doing the work yourself. Another consideration is the cash you've got available. If you've got a significant pot of cash, then that will open yourself up to a lot of different strategies. Whereas if you're relatively restricted, then you might be a little bit more limited in terms of the strategy that you want to follow or you should follow based on that. The final consideration is your goal. So if you have a very short-term goal, then you might have to do a more aggressive, more risky strategy like flips or project-based property investment. If you're willing to wait, and if you're willing to allow time to do its thing, allow property to grow in value as it will do in the long term, then you don't have to be as aggressive. You can go for some slightly more passive and safe investment strategies to help you achieve this long-term growth. The real key is aligning your strategy with your goals, cash available and time available. So they are the 5 main property investment strategies in the UK market. You may have heard of other strategies that probably are more like setting up property businesses like rent to rent and other things from that perspective. However, if you're looking to build your wealth through property investment, these are the best 5 to start considering. Don't go running off to invest in property yet. Before you do that, you need to get clear on your property investment goals. The next video will talk you through that. Click here.